Okay, a lot of you guys out there are wondering exactly why we look to this guy here, why we look to Jerome Powell to dictate to us exactly why the markets move, how the markets move, and when the markets move. We look at FOMC meetings, we look at these news events for a reason, guys, because it is him and it is the Fed that dictates exactly how the markets move. They dictate exactly when quantitative tightening starts. They dictate to us when quantitative easing starts. They dictate to us exactly what happens within the world economy because they have the world reserve currency. So we look at the dollar for times of strength, we look at the dollar for times of weakness. And of course, people go into dollars in the times of strength because it's the least risk asset within the fiat world. And that's why we look at the Dixie. So people hold the dollar because it holds up better against a bag of currencies within times of crisis. What we're going to do in this video is we're going to go back in time all the way to the financial crisis to find out exactly what impact the Fed decision has on the dollar and how that has a knock-on effect with the rest of the markets, so we can understand exactly where we are within the crypto cycle now and what signals that he can give us next to identify when the next big move is going to be, when alt season's going to be, and when Bitcoin's going to start to recover. Okay, so why are we governed by the Fed? Why do we look for the Fed for interest rate cuts, for interest rate rises, and why do these things happen? We're going to go back to the financial crisis, and I want you to think of the bigger picture, guys, and I want you to think of where the flow of money is, how the flow of money works, and when the dollar's strong, when the dollar's weak, what impact that has on other markets. So we go back to 2008, and I want you to think outside the box, remember. 2008, what happened? The Fed slashed rates to a range of 0 to 0.25, guys. That's interest rates to pretty much zero, introducing near zero interest rate policy during the Great Recession. Now, what happened in 2008, guys? The world was over leveraged, the bankers were irresponsible, mortgage was hugely over leveraged, and what is over leveraged needs to come crashing down. And that's exactly what happened. The irresponsible lenders of the banks needed bailing out. So we needed to stimulate the economy. We needed to print money, and they needed to use our taxpayers' money to bail out the banks. So there was a knock-on effect with that, guys, because the money went into the banking. The money went into the banking out of our pockets. Our currencies were devalued because there was more printed money to bail out the banks. So we had a knock-on effect where our money was devalued. They were getting more money for the irresponsible lending that was carried out. The dollar had to be weak. The interest rate needed to be near zero, because zero rates create more lending, and more lending creates stimulus in the economy, and that creates higher GDP. So it all has a knock-on effect, guys. But unfortunately, we're the ones that had to pay out of that, and all of that money didn't actually go back into the economy, so we didn't benefit from that stimulated money. Sometimes we do, sometimes we don't, but ultimately, you got to understand that fiat currencies are inflationary. Fiat currencies get printed, and things like Bitcoin are deflationary. When you have a deflationary effect like Bitcoin against an inflationary effect like things like the dollar, the pound, then that's why you get such a volatile move to the upside over that period of time between Bitcoin and between something that's inflationary. So in 2008, we had to bail out the banks. Fed had to bring the interest rate down to pretty much zero. That is weakening the dollar. That means that they're bringing the dollar down. They're bringing the dollar down. And that means they're trying to send a signal to the world that when there's a weak dollar, people can refinance at next to zero. They can go up to the US and they can say, right, okay, can we borrow $1 million? Can we borrow $10 billion? Can we borrow whatever? And they'll say, yes, you can borrow that for pretty much next to nothing. So a weak dollar means stronger markets, and we had to go through the banking crisis, for us to get that weak dollar. So we go through different times. What I want you to think about, guys, this is what I mean about thinking outside the box. So imagine you're the rich. Why is it important that you think about the rich? Because they're the ones that hold the capital. They're the ones that flow the money. Are they putting money into the economy? Are they taking money out of the economy? When you've got a strong dollar, that means you've got a weak economy. When you've got a strong dollar, that means that people have flooded into the dollar in times of fear, i.e. the world reserve currency. And that means one thing, guys. When you're flooding into the world reserve currency, that means the interest rate's high. And when the interest rate's high, that means the rich can put their assets into something stable when the world's looking bad. And that's why people flood into the dollar. So what happened here, guys? This is the DXY, remember? This is the monthly chart. So this is the higher time frame. The European Central Bank's dovish stance, May June 2014. Now, you've got to think about the DXY. The DXY is measured against a bag of currencies. The biggest bag of currency outside of the dollar is the euro. So the euro has a knock-on effect. Now, when you've seen that the Fed slashed rates here, you got a drop in the dollar. That was devaluing the dollar. Now, exactly the same thing happened here with the euro. So when the markets are moving up here, that means that the DXY is strong. That means that the euro is weak. Why is the euro weak? Because their interest rate's weak and the rich can't put their money into that weak asset because they're not going to get anything back from it. However, the world can borrow from the euro. So this is why the markets correlate. We can look at the Dixie and we can see how it's performing against the euro, how it's performing against anything else. But it is driven by the Fed, guys. It's all driven by news events. Now, this is the thing that I wanted to show you. This is the 2017 bull market. See, weak dollar here. That means strong crypto. Let's go back in time. So 2017, this is the 2017 bull run, strong crypto. So you've got strong crypto here. You've got a weak dollar here. So that's the crypto bull market. That is the bear market for the dollar. What happened, guys? Does this look familiar to you? Trump policy uncertainty. This is where President Trump got elected in the first time in his first term. Donald Trump's inauguration on 20th of January 2017 introduced uncertainty. His America First rhetoric included threats of trade wars, criticizing China and Mexico, and raising doubts about dollar-positive growth policies. His January the 11th press conference lacked concrete fiscal stimulus details. So what it was saying is there was uncertainty when President Trump got elected the first time. He was threatening trade wars. He was threatening tariffs. He was criticizing China and Mexico, and that was raising doubts about the dollar growth policies. Trump wants a weak dollar, guys. Trump wants a weak dollar. There's no getting around it. Trump wants a weak dollar. Trump's asking for a weak dollar, and I've been saying it time and time again. So what happened down here? This is 2021. Federal Reserve's hawkish pivot. So November 3rd, 2021. You've got to remember this, guys. This is the end of the crypto bull run. 2021. This was the crypto crash. When Bitcoin dropped this far, altcoins dropped even harder. Some of them dropped pretty much next to nothing. And then the dollar went through its bull run. So when Bitcoin, everybody's coming out of Bitcoin, the institutions, the smart money, they're coming out of Bitcoin, they're coming out of Bitcoin. Where they're going? Somewhere that can get a strong interest rate because the interest rates are going up. So when the Fed is hawkish, that means that the interest rates are going up. When the Fed is dovish, that means the interest rates are going down. It's all about putting things into the economy and taking things out of the economy. Whether they're holding treasuries, when they're getting rid of the treasuries, all about what the Fed's doing. And that's why we're looking here right now on the Dixie. It's because we've got signs of a weak dollar. Signs of a weak dollar indicate alt season, guys. And that's what we've been waiting for. Once we get this drop, this is the monthly candle, guys. This line here, let me make it a different color. Let me make it green for bullish. This line here represents one thing. If we drop this on the monthly, we can expect further downside on the dollar, further weakness on the dollar, and that will create strength in other markets like cryptocurrency. This is the total market cap. When we see weakness in the dollar, we see strength in on-risk assets. We see strength in high-risk speculative assets. Guys, it don't get much more speculative and high risk than cryptocurrency. That's what we're in the game for. That's what we're here for. That's what we're trying to take advantage of. So let me know in the comments, guys, if you did find this useful. I'll do more videos like this from a macro perspective, but it is critical to understand that the world is a bigger picture, guys. It's not just cryptocurrency. We need to understand exactly what Jerome Powell's doing, what the world's doing, whether we're looking strong, whether we're looking weak. And we can do it on a higher time frame and understand exactly how you can take advantage of the cycles. Take care. Goodbye from me.